Hello, everyone. I'm Dan Siccardi, and I'll be moderating today's live-streamed Series 2020 program. I'm a Senior Director in our company network and lead our work with 16 financial service sector members. Series is a sustainability nonprofit working with some of the largest and most influential investors and companies from around the world on a host of sustainability challenges, including climate, deforestation, water scarcity and pollution, as well as inequitable workplaces. I'd like to start today by saying that our hearts go out to all those seriously affected by the coronavirus pandemic. We're especially grateful to those on the front lines working hard to ensure we all stay as healthy and safe as possible. I also want to thank each of you for participating in today's program, Innovative Approaches to Sustainable Finance. We realize that your personal and professional lives have been profoundly disrupted, and your participation really does demonstrate your commitment to our collective mission of building a just and sustainable economy. We also appreciate the generous support of our speakers and sponsors, some of whom you'll be hearing from in a bit, who have stood by us in this digital journey to reimagine Series 2020. Together, we've been able to transform our intended in-person convening into a series of digital programs, and we clearly would not be here without all your essential support. This pandemic has not only dramatically changed our world and our way of life, but it's shining a light on the universal interconnectedness and vulnerabilities to the seismic risks that have rocked our current capital market systems. Whether it be a deadly virus or climate change, we are experiencing firsthand the need for collective action and mass mobilization. This is where you, as capital market leaders, are uniquely positioned to positively influence both our economic recovery and our preparedness to help prevent future crises. You can help safeguard our economies, communities, and workplaces and workers by ensuring that net zero carbon industries not only withstand downturn, but are incentivized to grow. Going forward, we'll be counting on you to make sustainable investments and finance decisions through the lens of equity and climate resilience, dollars to net zero solutions. So before we jump into this topic, just want to cover a few housekeeping notes. First, this session will be recorded, and we'll send out a link of the recording to our attendees following its completion. For those who are listening in, if you have questions, feel free to enter them in our chat box. We'll do our best to get to as many questions as we can towards the end. And finally, just want to note that given the global bandwidth issues and demands, there's a possibility we may have technical issues. They'll really be beyond our control. If that does happen, we'll pause the conversation for 30 seconds to allow bandwidth to adjust, and then we'll pick up. And so we want to thank you for your patience in advance should anything arise. So now with that, it's really my pleasure to introduce our three speakers and get into the heart of our conversation. So I'll just quickly say their names and organizations, and then we'll turn to each of them for just a quick intro of themselves. So we're joined by Aaron Robert, Head of Impact Finance at JPMorgan Chase, Matt Slovic, Managing Director and Head of Global Sustainable Finance at Morgan Stanley, and Mary Wenzel, Head of Sustainability and Corporate Responsibility at Wells Fargo. Aaron, do you want to kick us off?
Happy to. And first, just a huge thank you to the series crew for persevering and still enabling us to hold this session. So again, Aaron Robert, I'm responsible for JPMorgan Chase's impact finance efforts. We'll delve a bit more into what we do on the ground level throughout the session, but broadly, we are deploying $250 million of low-cost, non-standard capital that is meant to fit somewhere between what our philanthropic organization does through grant making and what our businesses traditionally do, in their day-to-day. And really, we're focused on solutions that advance environmentally and socially sustainable alternatives. And just by way of background, I've been at JPMorgan for the last 14 years. I started my career on the public financing side, working with U.S. municipalities to advance their financing objectives, and then also did a stint on our commodities team.
Okay, thanks, Aaron. And Matt?
Hi, echoing, I guess, both of you. Thanks to Series for having this webinar and persevering, as Aaron said, and also, to everyone who's watching, via the web. I hope that this finds you and your families healthy in such a crazy time. So by way of introduction, Matthew Slovic, I lead Morgan Stanley's Global Sustainable Finance Group, which is a group that was formed over 10 years ago to really think about how we can integrate impact and sustainability and ESG into what we do across Morgan Stanley, how we operate, and most importantly, how we serve clients, recognizing that at the end of the day, it's going to take the scale of the capital markets and connecting capital and solutions to really help address the most burning questions. We also lead Morgan Stanley's Institute for Sustainable Investing, which was formed by our chairman and CEO in 2013 to do a number of different things, including really support innovation across our businesses and in partnership with our clients as it relates to sustainability, thought leadership, including a real focus on market building, and third, doing work around capacity building, supporting the next generation of leaders in finance to think about sustainability. So we'll talk a lot more about these as the webinar goes along, but I guess on a personal note, I've been at Morgan Stanley 15 years, started in investment banking as a first-year analyst out of school, and have had a number of different roles over that time. So thanks.
Thanks, Matt. And Mary.
Thank you. And hello, everybody, and thanks for joining us. And thank you, Ceres, for really creating this sense of community among kind of sustainability thinkers and practitioners. So really appreciate the chance to be with you all today. And just wanted to echo your call out for frontline responders, including many of our fellow employees who are kind of critical employees at bank branches, helping respond to customer needs right now. Really important work that our frontline workers are doing across the economy. And so just wanted to take a minute to acknowledge and recognize them. So I manage our sustainability and corporate responsibility function. I've been here 15 years as well, so that's a common theme of all of us. And our job is really to embed a focus on sustainability and ESG matters across the enterprise. So we believe it's really critical that we use all our levers to really accelerate the transition to a low carbon economy, from walking the talk in our own operations to engaging with our suppliers and clients, to really bringing our lines of business to the table to provide financing and expertise.
Terrific. So with that, let's jump in, maybe starting with you, Matt. If you could really just think a little bit across the landscape of sustainable finance, provide a snapshot of what you see that's looking like from Morgan Stanley's perspective, what you're doing, and why perhaps there's a need for continued innovation and really stepped up ambition generally, and maybe even particularly in the current climate with COVID that we're facing.
Sure. Thanks for the question. I think maybe a couple of things to ground this. First off, I think it's great if you just look around the webinar, right? Morgan Stanley, Wells Fargo, JPMorgan, all taking slightly different approaches, but all focused on trying to really mobilize capital and sort of tackle these challenges in different ways. From a Morgan Stanley perspective, since we launched our group, over a decade ago now, I think it's safe to say that the market for sustainable investing has exploded, changed very, very dramatically. When I look at the landscape now, the breadth and depth is pretty remarkable across asset classes, across geographies, across client segments. And one of the things that the Institute does, as I mentioned, around field building is trying to get a pulse of the market. Our latest asset owner and individual investor polls actually say that roughly 85% of those investors are interested in sustainable finance, and for the asset owners in particular, 60% of them have really started focusing on this in the last 4 years, right? So you're talking about huge velocity, and I think that probably mirrors what a lot of people on this webinar have seen. I think transitioning to sort of innovation, and then maybe I'll come back to the Morgan Stanley piece. I think innovation in sustainable finance is key because everything keeps changing. if you look at, a few years ago, a focus on trying to open up the market for community development finance institutions to be able to tap the capital markets, to literally last week thinking about innovation as it relates to COVID and COVID-related resource bonds that are hitting the market. Right? We need to adapt. The market keeps changing, and we need to be able to stay focused on it. So how am I thinking about this from a Morgan Stanley perspective? I think there's really three things to hit on. One is we are very focused on integrating ESG, sustainability, and impact into our businesses. We have a very diverse group of clients, everything from hedge funds to individual investors, large asset owners, corporate clients, really helping them think about ways to push the needle and innovate as it relates to sustainable finance, and often doing so with the guidance and support of our external advisory board that's part of the Institute for Sustainable Investing, that includes leaders across social issues and environmental issues, traditional finance and sustainability finance. Mindy Luber, is great on the board. Rosina Bierbaum, Darren Walker. So just to give a sense of Mary Shapiro, just kind of a sense of the type of guidance. And so really thinking about how we can mobilize our businesses in this way. Second, I think it's really around data and analytics, and I think that we've seen a lot of information and development in that market. So thinking about everything from the reporting side to new ways that we can serve client segments that historically have not been as engaged around sustainable finance, but are key to moving the needles on some of these big challenges. So I think about, we launched something last fall called Morgan Stanley IQ, which is really a reporting application and analytics application for our wealth clients, and continuing to do work broadly on the quantitative side. The third area is really around capacity building. So big area of focus for us with a fellowship with Columbia, partnerships with Michigan and University of Georgia, and most recently, it goes back 7+ years now, but with Kellogg, where we just had the Kellogg Morgan Stanley Sustainable Investing Challenge at the end of last week. Went virtual for the first time in its history, but brought in business school students from around the world with a real focus on innovation. And so we have our winners, which will be announced, I guess, today or tomorrow. But really exciting and inspiring to see the way that business school students are really focused on this and bringing this into their jobs as they think about finance. So I'm going to take a breath there and make sure I hand it back to you.
Great, thanks for that, Matt. I think we'll return to pieces of that throughout. But Mary, maybe just building on the points that Matt was raising as it relates to innovation. Wells Fargo has been running an innovation incubator for a few years now. Can you talk a little bit about that? How that's working and how the lessons you've learned from that in terms of how that's helping to stimulate investments in new technologies or business models?
Absolutely, thank you. So we formed the Innovation Incubator back in 2012, and we saw a real need to help clean technology entrepreneurs overcome the valley of death. And so we wanted to use our expertise as we had many relationships with incubators and accelerators and the National Renewable Energy Lab. We had a clean tech commercial banking business that had a lot of expertise in the clean tech space and how clean tech was going to impact our clients. And so wanted to bring together that expertise, the ecosystem of incubators and accelerators in a really strategic way to help those clean tech entrepreneurs cross that valley of death and come to commercialization much quicker. And so we work with 60 incubators and accelerators across the country that are really identifying the most promising entrepreneurs, the most promising technologies. The National Renewable Energy Lab on the commercial building side and residential building side helps to validate those technologies, helps those entrepreneurs refine their technologies. The Danforth Plant Science Center in St. Louis helps us with sustainable agriculture entrepreneurs, helping them refine their approach to the technologies. Those entrepreneurs get non-dilutive funding to really stabilize their businesses. They get to have their technologies refined in a laboratory setting, and then sometimes they get to beta test their technology. So we've beta tested their technologies in our own footprint. And what we found is that by driving that focus on really solving for that valley of death, by creating an ecosystem model and forcing collaboration, sharing learning across that 60 plus set of incubators and accelerators, we've been really successful. Our 40 entrepreneurs that have been through the program have been able to raise $262 million in follow-on funding. For every dollar we've invested, they've raised $28, so quite successful. 6 of those companies have graduated to successfully exited the program through mergers and acquisitions. And so we really invite others in to support this model. This isn't a proprietary model. We know we need to support the best and brightest entrepreneurs that are solving real world problems. We know the clean tech sector is particularly hard hit right now in terms of being able to attract funding, needing support like all other small businesses. And so we've refunded the program. It was a 30 million program. We just committed to another 4 years of funding, so it's a 50 million program. But we're absolutely looking for other partners to support us and to be able to scale more entrepreneurs more quickly.
Great, thanks for that. And Erin, now that we heard the approaches from Wells and Morgan Stanley, could you kind of share the approach that JPMorgan is taking, what unique strategies or approaches you might be focusing on to really try to accelerate investments in this space?
Absolutely, Dan, and I think you're going to hear a lot of the same recurring themes that Matt and Mary raised as well. So I think just overall, and to frame up the big picture, we know that the transition to a lower carbon economy and frankly, integrating a more inclusive economy from a social perspective are 2 very large issues that require, frankly, all of us on this webinar, all of us attending this webinar, but firing on all cylinders. And I think we've certainly been helped by the fact that the ESG movement has really moved from, I'd say, more religious to more secular, and bringing more folks into the movement itself. And we've certainly seen that at JPMorgan Chase. And so for us, there's a group of us who sit on the sustainable finance team, of which the impact finance team is a part, that one, looks at how JPMorgan as a corporate performs on an ESG, from an ESG perspective. Our commitment to 100% renewable energy is run out of this group, as well as our transparency and disclosure, whether it's working with the TCFD, working our own climate report, our work with the Climate Leadership Council, really to ensure that as Mary said, that we walk the talk as well as a corporate. And then on my team's side, we're really focused at working throughout the lines of business and then plugging in the gaps where we see them. So for example, across our lines of business, we've seen a significant uptick, as my colleagues have pointed out, in sustainable finance activities writ large. And we've been building out teams, frankly, to respond to that need and also to anticipate the changing economy that our clients are having to adapt to. And so what that actually looks like and the way it's manifesting is an energy transition team being built out for oil and gas clients who are really trying to figure out how they are going to meet the needs of this economy that's moving in a greener direction. It's ESG advisory solutions for some of our investor clients who are really trying to figure out how they execute in an authentic way on some of their green and social commitments. It's in our asset management group joining the Climate Action 100. It's in our private bank where a lot of our clients are trying to execute on their own ESG hypotheses. And our team jumps in where we see that there are gaps in funding and where we know that lower cost capital is actually required in order to reach market-based, more scalable solutions. And so we'll jump in on transactions such as affordable housing deals. We closed a couple in December of last year in the Bay Area, knowing that that's an issue that has acute challenges where very concessionary and or flexible capital can really move the needle and get more projects developed. And it's doing so with a green lens as well, ensuring that folks across the income spectrum are able to see the benefit of a greener economy and incorporate things like energy efficiency into their day-to-day lives. And so that's where I think we're seeing that broad-based action. And also I think institutional flexibility around ensuring that we can help get more projects developed, whether green or socially oriented.
Great, thanks for that. And maybe just a follow-up to the three of you and you're all, it's great to hear that the program's underway and your approaches. And Erin, you began to speak to this a little bit in terms of the scale of the challenge. Could you each maybe just talk a little bit about what you see as some of the main challenges that are still in place despite all the good work that's being done, that might hamper the real scale of investment that we ultimately need to see to get to a zero carbon future?
Well, I'm happy to jump in. Well, so I think there are some structural issues that we see, and I'll focus on the green space where look, we see that public sector intervention is required in order for traditional capital to follow. And so in particular on project development, some of this is we're seeing there's actually a dearth of projects that are investable in order for large banks to step in and to provide the type of capital really needed to move the needle. And so we're working with the public sector, frankly, to figure out how do we ensure that feasibility studies are conducted in a way that's going to set up an investable asset. How do we work from a technical assistance standpoint with governments who are looking to facilitate more development, in particular in the emerging markets? And then on in the developed market side, it's also ensuring that we have teams that are there to take to really execute on some of the public incentives, so production tax credits, investment tax credits, and that those are seamlessly integrated into capital structures. And in certain cases, there's going to be a gap, and I think that's the area where we're all playing. I mean, I affectionately refer to what we do as weird finance. And that, frankly, is where things they get a little murky, right? Where we know that either public sector dollars are required, or we all have to get creative around how we get comfortable with certain risks. And so that I think is where we play, and really trying to learn from the weird finance transactions that we do to apply them to scalable market-based solutions. So we're not just simply throwing 0% money at a solution. It's we're taking the learnings from a given project and pulling them back into our credit process in the traditional businesses.
Okay, thanks for that. Mary or Matt, do you want to add anything to that?
I think that's exactly right. I really think it's about how we serve clients and support opportunities that don't fit our normal risk return parameters. And so how do we become more innovative, more flexible, more responsive to what either public sector or commercial clients are telling us? They are seeing the trends. There's not a GIB client, government institutional client, that doesn't see the need for enhanced resiliency out there. It's just a matter of how you fund it. And so we've got to walk this journey with our clients and kind of develop those new approaches with our clients.
Yeah, and I guess maybe I would tackle it in two different ways. One is I think we need to continue to focus on solutions for investors across the spectrum, from large asset owners and thinking about how to decarbonize portfolios to institutional investors that may historically have not been some of the drivers of capital around low carbon opportunities, but thinking about how to bring them into the fold. Institutional investors who are increasingly interested in investing along with their values. And I think that as we continue to provide those solutions, we will help drive capital at the scale that we need to help make changes. The second piece, which I think is in good news, has become less of an issue recently. But I think historically for investors, there's always been a bias that thinking about sustainability would negatively impact your returns. And I think there's a growing body of evidence, not just from schools like Harvard Business School, Oxford, LSE, and others, but continuing, especially in the face of volatility, to look at the performance of ESG and sustainability as an example. And the Institute for Sustainable Investing published a piece called Sustainable Reality that looked at over 10,000 mutual funds and really came to the conclusion that sustainable products perform in line with traditional products and often with less volatility and downside. So I think we've seen stuff recently come out from Morningstar and Bloomberg supporting that, and I think that has historically been a roadblock, but it's I believe it's been chipped away, not gone, but chipped away.
Great. Thanks for that. And speaking of the scale that's needed to the point that Matt was raising, want to shift a little bit to some of the sustainable finance goals that your respective firms and many other banks have set in the order of 200 billion by 2025, 2030. Noting also, as you mentioned, I think earlier in your intro, Matt, that the space has grown very rapidly and that there's a natural growth going on there to a certain extent. Would be interested, Matt, from your perspective, do you think that the goal that the Morgan Stanley set, 250 billion by 2030, is that something that's driving behavior change? Is that something that bankers are keenly aware of, and are they specifically incentivized to help meet that goal?
So maybe I'll take the last part first. I would say that our bankers and all of us are incentivized to meet our client needs. And I think our clients are increasingly talking about sustainability, increasingly talking about ESG, and finding solutions there. I think, and you see this where I think it's in the first quarter of 2020, something like 600 mentions of sustainability or ESG on earnings calls versus something like 200 5 years ago. So clearly the conversation on behalf of our clients is changing dramatically. I think what it does do is it helps focus attention on some of these firm strategic priorities. So whether it's the low carbon financing goal or the plastic waste resolution that we launched last year, I think what you're seeing is an engagement with our bankers and our teams across the spectrum to find solutions that can manifest themselves in many different ways to help address these solutions.
Gotcha. And Aaron, JPMorgan took a little bit of a different approach at the end of last year, kind of moving away from the 5-10-year goal setting and focusing on a single year goal. I'd be curious to get your thinking on why you went that approach, if it had anything to do with, I think, for lack of a better term, something we're hearing about, announcement fatigue when, some of these long-term goals are being set. Can you talk a little bit about the approach JPMorgan's opted to take?
Yeah, absolutely. And I'll say this is where people in the audience usually laugh if they know me, because they've heard me rage about some of these. I was really skeptical when we made our first announcement in 2017, to be perfectly honest. I was like, I don't know what this does. This is work, that we're working toward, we're increasing. As a cynical former banker, I was like, I don't know if this is really going to move the needle. I was wrong. We've actually found that, one, it's been a great, having a commitment, and I'll come back to what we did this year, but a commitment has been a really solid and tactical organizing framework for the business. And I think it's made discrete lines of business that weren't necessarily talking as much, talk more, and really think through how what they do in their day-to-day was contributing toward this larger goal. So I ate my words on that. And I think also, it's just an easier way to communicate all of the things that are happening across the institution. Just walking through even the new teams that are developing, the way folks are working together, that's not as snappy as, hey, we've committed to facilitate 200 billion. Those are big numbers, and it's more tangible, I think, for folks. This year, though, we did take a different approach, in part because we've made a large percent. We've nearly met the commitment already, to be honest, and expect to hit that original 200 billion by the end of the year. And so this year we really kind of paused and asked ourselves the question again: is it worthwhile to do a commitment? Are these numbers so big? Do people even know what that means? And this year we pivoted to do an annual number that encompasses green, social, and development, in part because we were, taking stock of the conversations that were going on around the firm. And very rarely do you hear people talk about green, social, and development in different ways. These are conversations that are overlapping and occurring. You can't have sustainable development without, keeping in mind kind of the social consequences. You can't think about affordable housing without now factoring in energy efficiency. And you can't think about green without thinking of the social implications thereof. And so in our minds, these are all kind of merging and advancing the sustainable development goals writ large. And so as we were looking at what would a longer term commitment look like, again, the numbers just get so big, it's like, does it lose its context? And so what we expect to do going forward is kind of set this annual target and then, troubleshoot and see how it goes. But really acknowledging that these are three themes that are now kind of flowing together.
Great, thanks for that. And Mary, I want to ask a question about impact measurements. I think we've heard a lot of discussion and debate in the sustainability community about how some of these goals and financing activities actually translate into real world impacts, particularly in the context of greenhouse gas emissions. And so could you talk a little bit about how you think about measuring impact when you're dealing with sustainable finance? What your approach is to try to measure that, what metrics you might have in place?
Yeah, thank you. I think it's a great question and couldn't agree with Aaron more. We set our first sustainable finance commitment in 2005. It was $1 billion. We didn't know, what would count, what wouldn't count. And so engaged Ceres actually to help us define sustainable finance and what we should count towards that goal. We've upped it 3 times since then. And I agree with that it creates a unifying narrative, that it brings focus and attention, and all of those things are very positive. But the numbers get so big that our stakeholders would tell us we don't know what that means. We don't know how that compares to non-sustainable finance, if you will, that you're doing as a company. And so from our perspective, we think it's really important to be transparent and to really discuss what we are counting, what we're not counting, how we're counting different transactions. And so we've published our sustainable finance accounting methodology and again, worked with Ceres to help us create that approach. So we want to be, open, kimonoed about what we're counting towards our public commitments. And I've also committed to start to discuss the carbon intensity of our lending portfolio. So on both sides of the equation, we want to show, we believe that we will show over time that the carbon intensity of our lending portfolio is decreasing as our clients move to adding renewable energy or to more sustainable business practices. And so I think it's very important that we are transparent, that we engage with our stakeholders in a dialogue, and hopefully we'll also publish our first TCFD report this year as well.
Great, thanks for that. And just for a little teaser to the audience, this topic of carbon accounting and measurement is something that we will be returning to with Wells and some others later on in the May-ish timeframe, so stay tuned for that. Matt, want to ask a question that I think we think about quite a bit and know that some of our other peers in the NGO community think about, and that's this issue of additionality. And the thinking there, again, being that given that the renewable energy space is growing pretty rapidly just based on the economics, how do we generally, and how do you yourselves as institutions providing this financing, get a sense for do things like the goals you're setting, is that driving new incremental activity that might not have happened as a general course of business? And so can you talk a little bit about how you think about that, what approaches you might be taking to try to quantify that to the extent that's something you're doing?
Sure. Thanks for that. I do think that's the case, that it is driving incremental focus. But look, let's be honest here. These are big problems, big challenges that the world faces, and we need to move capital at a very large scale to move all of this forward. So the way that I think about success, frankly, is less about whether an individual transaction would or would not have happened without our firm's commitment to sustainable finance, and instead think about how can we drive this deeper? How can we serve more clients? How can we drive more money towards low carbon financing? I think that's the only way you're going to solve this. And I think about it as authenticity, maybe in some cases, as opposed to additionality, because I think it's important that we lock arms, across the spectrum, across the corporate spectrum, the institutional investor spectrum, the individual investor spectrum, and really think about how to put more money, capital, and innovation to address these challenges.
Thanks for that. Maybe, Mary, a question to you. I think another topic that comes up is whether or not a lot of this is focused more purely on corporates and project finance versus other activities that the banks are doing. And so wanted to get your sense of, should there or could there be perhaps more of a broadened focus to other areas of the banking, such as underwriting, retail lending, derivatives, whatever it may be, in addition to the important focus on corporate and project finance?
Yeah, I think you're hearing it today. It is being embedded across products and lines of business. We too have a very focused wealth investment management group that is delivering ESG offerings across our different investment categories. We are a participant, as the others are on the phone, in the green bond councils and principles, and are delivering green bonds and increasingly COVID and social impact bonds as well. We certainly, as a large commercial bank, middle market bank, are working with our clients on the debt side, and we're seeing more kind of sustainability linked pricing mechanisms, primarily coming out of Europe, but increasingly here in the US as well on large syndicated agreements. And so I think the notion that this is only for project finance or investment finance doesn't really hold for us. I mean, we're really approaching it across our businesses, and that's the bulk of what we're doing, frankly, is not project finance. It's really debt or asset management or bonds and underwriting.
Great, thanks. And so maybe related to that, and really kind of open up to any of the three of you, do you think or do you have goals? And if not, what goals might there be that could touch other areas of bank activity? It's probably most concrete and easy to think about some of the sustainable finance goals that your various institutions have been setting, but are there parallel goals that you either have or perhaps could be thinking about setting to address some of these other areas of activity?
So, from the JPMorgan Chase perspective, I think we're always looking for ways to embed additional impact or ESG overlays across products. I think, to Mary's point, this is not a monolithic sector, right? Green, sustainability, impact. It's an overlay across all of our lines of business and across all of the products therein. And so I think, as we look ahead to, what comes next, it isn't simply what business aren't we doing? It's what business can we be doing? And how do we work with our clients who are really trying to be at the forefront of this thinking? And what are the different ways, frankly, not even necessarily to innovate in financial products, but to apply financial products to impact environmental and social initiatives in new ways. And that's actually where I think the innovation comes. It isn't necessarily in coming up with some new ESG product. Green bonds are one example of a pretty vanilla product that had a green overlay, and they've been so successful in part because they aren't super innovative. They're an instrument that investors are accustomed to buying. It's the same underlying credit that investors are accustomed to buying, and they can go to their traditional risk committees. And so I think all of us on the line here know how valuable that is when you can say, this product isn't so different, but here's this new tweak that we want you to consider. And that's enabled the growth. What that does too is it changes the vocabulary of the traditional investor. It gives them a new language to speak, and all of a sudden investing in something that's green isn't foreign to them. And so that, I think that's in part why we've seen this expansion and acceleration of broader ESG investing. It started with traditional financial products, and now it's expanding. And that's where I think the innovation comes in, and where we get really excited.
I think from my perspective, I think that's right. I think that the less you have to explain, the easier it is to adopt, and I think that has gone a long way in helping drive the conversation. You know, when I think about goals and I think about our business, you know, there's a low carbon financing goal, obviously, that I think has helped bring additional attention to the issue, foster conversations internally and with our clients. The plastic waste resolution that we launched last year to help prevent 50 million tons of plastic waste essentially from entering the environment, which is a major economic challenge. Something like $100 billion a year leaves the economy just as it relates to single-use plastics, and so single-use packaging, excuse me. And so thinking about how we can help activate our entire firm's business lines to think about connecting capital with solutions around plastic waste, not plastic, which we all know, especially, you see it front and center these days. There are some amazing uses for plastic, and everything from lightweighting materials to medical equipment, but the same attributes that make it a great material also can make it challenging. When I think, to your question about setting goals as well, I think about every part of our firm, and I think about ways that we can bring all of our clients into the conversation. Our hedge fund clients, our institutional investor clients, our asset owner clients, our wealth clients. I think when we can have meaningful solutions across everything from debt issuance to structured finance to asset management to wealth management advisory, I think that's how you're going to help really push innovation by bringing everyone to the table and having solutions available for every client segment.
Great, thanks. So we are definitely getting some audience questions that we'll be turning to in a moment, but perhaps may just throw one more out there. We'll start with Aaron, but really Matt and Mary, feel free to chime in as well. Building on some of the points you're making, Aaron, about the case for why green bonds have been attractive. Looking at all of these sustainable finance products, in addition to the direct economic benefit they may be providing, what additional benefits do you see that might justify different pricing or opportunity evaluation, whether it's maybe about alpha and outsized returns, or beta to really mitigate risk, or anything else? What do you see as a real kind of internal driver in addition to maybe just customer demand?
It's a great question, and as we think about our engagement with clients, one of the biggest questions that we get is, we're in a different world. The Business Roundtable statement earlier, late last summer, I think drove home for a lot of folks that business as usual is just not the path forward. And so I think as our in particular corporate clients have been thinking about, okay, how do I operate in this new world where social consciousness is no longer, on the sidelines. It's front and center. I think they're looking for ways to tell their story in a new way, in a way that's organic to them and their business. And so some of these financial products that have emerged, and Mary alluded to, whether it's sustainability-linked notes, revolving credit facilities, and the like, are a way for our clients to denominate their commitments in a way that makes sense to them and speaks to the fact that this is, these are issues that are organic to their businesses as well. And so I think there's some element of marketing associated with that is beneficial to them, but it's also a way to get all parts of their organization involved. When all of a sudden you've got treasurers, CFOs, finance teams writ large, thinking about ESG issues in addition to the supply chain folks, all of a sudden you've got two teams that don't necessarily speak frequently really coalescing and coming up with valuable solutions. And so I think that matchup of different teams within firms talking to one another is highly beneficial, and I think one of the kind of unspoken benefits of the new wave of ESG products.
Great, thanks for that. Mary or Matt, anything you'd like to add to that?
No, I'd say we're seeing the similar value in our own business and engagement, right? So we have a virtual clean technology renewable energy group that brings in expertise from our renewable energy finance team to work with our utility clients, that brings in folks from our clean tech commercial banking group to add value in relationships and other parts of the business, right? So as much as it's creating that cross-enterprise engagement for our clients, it's creating that within our own organizations and really enabling us to leverage expertise and capabilities in a really powerful way that we haven't done through other kind of focus areas. Frankly, I think it's really an opportunity for us to be much more collaborative across our organizations, to bring different areas of expertise to support our clients holistically. So I think it's been a value, frankly, for us as much as it is for our clients.
Yeah, I think that's right. I think we're seeing very similarly collaboration, bringing together different parts of the firm to really focus on innovation in the space. I think that the point about sort of the messaging around all of this and sustainability becoming core, it's no longer for many companies sort of a side project or a purely a marketing spin, but instead really seen as strategic. And one of our goals as well is to help our clients tell that story through finance. And I think that finance is becoming an ever important part of that storyline as investors really, I think, are starting to bring some of the lens that they historically have to things like food and clothing to finance, and trying to understand what's going on, the transparency, the ability to focus on key issues as part of their investment and financing decisions, I think is also a major component of sort of moving the conversation forward.
Great. So with that, we are getting some questions. So we'll turn to some audience questions. And this first one is building on Aaron's point about business as usual not being a path forward. But the question is, as we're thinking about transition to a low carbon economy, there are certain industries that are inherently high carbon, specifically the fossil fuel industries. And so the question is, while we're seeing a move away from coal to some extent, we're also still seeing significant investment in the fossil fuel sectors. So at what point do you see this changing, and why do you think it's not moving as quickly as the urgency that the science is calling for it to?
Well, I'm happy to kick off. So I think just first stipulation, this is a huge challenge, and we've all alluded to this and different comments that we've made. I'll plug, if you're not reading Axios Generate newsletter every morning, do. Amy's collection is great, and today first story is the IEA's data production, basically the carbon reductions required to meet the 2-degree scenario. And sadly, I think COVID has actually put us on the path, but even with the massive demand reductions, lack of travel, and the macro changes that we've seen in the cataclysmic demand reduction, we're still not on the path. And so I think that is a sobering detail for us, and that's what's happened with this cataclysmic change. And so what we know is we can't do it overnight, and that's why I think an orderly transition itself is exceptionally important. And so as we think about what that looks like, it means working with our fossil fuel clients who are working to electrify, who are working to diversify their asset base so that it becomes cleaner. Because we know if this change happens overnight, we're going to see similar shocks that we're seeing today. That is not to say that this isn't important and isn't a change that needs to happen quickly. But it does mean that we need all of these minds figuring out how to do it as rapidly as possible.
Matt, want to add anything to that?
Yeah, I guess I would just add that fossil fuel companies are energy companies, and I think there's a perspective, obviously that they need to be part of the transition. And I think that there are different ways to really think about decarbonization. And we've been spending a lot of time with our clients, thinking about ways to help move down that spectrum. And yeah.
Great. So next question is addressing ESG reporting and asking about how effective do you all think ESG reporting has been in driving capital flow to low carbon opportunities? In what ways do you think ESG indicators really need to evolve to reflect what true good leadership looks like? Or should
Go ahead.
Sorry, go ahead, Mary.
I was just going to say, if you think about it, I mean, we published our first corporate responsibility report in 2013. So it's a relatively new practice, ESG reporting, right? We're only, less than a decade into kind of ESG reporting. I think it's evolving quickly. I think it's becoming more robust. I think people are looking for, investors in particular and other stakeholders, more consistency in reporting, more meaningful metrics, KPIs that are really showing, as you discussed, kind of change in practice and approach. But I think it's a really evolving space, frankly. I think we're all trying to enhance our disclosure and reporting and transparency as our stakeholders engage us, as our investors engage us, and seek more of that, frankly.
Yeah, I would agree with that. I think that there's a couple of different aspects to this. I think on one hand, and to sort of stay away from the need for harmonized metrics across everything, I think there's a couple of different focus areas. One is I think that that reporting needs to be client-centric from an investment perspective, because I think all of our clients have different goals that lead to their approaches to sustainable investing. And I think reporting has been a very important aspect of the growth in the market. The other thing on the corporate reporting side, the world has, to Mary's point, really come a long way since we did our first sustainability report in 2009. And I think, SASB and TCFD, which are places we've been very engaged, really doing a lot of work to really try to focus on, from a corporate perspective, the investor relevant disclosure items. I think there's clearly an evolution ahead of us here, but I think both on the sort of investment reporting side as well as on the corporate disclosure side, we've come a long way, and it's a very important area of focus as we look to the future.
Okay, thanks for that. A third question is around investment in the non-energy sector, and the question is that given that the energy sector has gotten, for many good reasons, a lot of focus in terms of sustainable finance commitments and actual capital flow, the question is about looking at deforestation, and that it makes up 20% of the carbon problem, but gets comparatively less of finance. I think you could say the same about water or biodiversity. Are these other areas on your respective firms' radars, and how are you thinking about moving capital flow into some of these areas that may not be as easily addressed as, say, renewable energy?
Yeah, I mean, I think all of these issues go hand in hand, right? That you can't deal with any one of them without touching on others in many cases. I think, finding ways to help identify meaningful investment opportunities across each of these, I think, is an important area to focus. I think when you think about climate change, it's not just about energy. It's about energy, and it's about agriculture, and it's about consumption. There are a number of different areas that really need focus in order to tackle climate change. It isn't any one of those, and we're focused on whether it's private equity solutions or capital market solutions, thinking about ways that we can help direct some of that capital to address these issues broadly.
And I think you have to look at where we individually as institutions have relationships, have expertise, have leverage. We're a large ag banker, so you can bet we are engaging our agricultural clients in a sustainability discussion. We're a large lender to the commercial real estate space. Buildings account for a big portion of our greenhouse gas emissions. And so it's really important, I think, to look at your organization's model where you have opportunity.
Yeah, and I'll just say I love this question because I think the climate change conversation oftentimes does get boiled down to is this, we need to make the transition to renewable power, and that constitutes 30% of aggregate energy demand globally. So it's a small part of a much bigger story. And JPMorgan Chase partnered with the Nature Conservancy a few years back to found Nature Best, which in particular is looking at interventions that can finance sustainable forests. And to Mary's point, this is also about ensuring that we can tell a more complex story internally. Frankly, I see a lot of the, please think before printing this email banners. And if only it were that easy. In point of fact, we actually want people to use paper that's been produced from sustainable forests because that is a revenue stream for them. And we want to reward folks who are engaging in forestry sustainably. And so I think it is incumbent on us to try to tell the more complicated story, that this isn't just about renewable power. There's a broad ecosystem that needs changing in order for us to tackle this large problem.
Terrific. Well, I think we could probably keep going all afternoon, but in the interest of time, we'll probably have to leave it there. I want to thank my three panelists, Erin, Mary, and Matt, as well as everyone who tuned in. Before we adjourn, did want to once again take a moment to thank our sponsors that you'll see on the screen in a moment. The support that they provided has really made this Series 2020 possible. For those interested, once again, you will receive a recording of this webinar to follow, so you can revisit this or pass it on to others. And for those who are interested in future programming, we'll have a Climate Action 100 Plus investor engagement with companies for a net zero economy. That'll take place on Thursday, the 23rd at 11 a.m. Eastern Time. If you're interested and you haven't already done so, feel free to register and learn about upcoming sessions. Go to www.series2020.org. And with that, thanks again for everyone's time here today. And we are now adjourned.
Bye, everyone. Stay safe.
Thank you.